All right, guys, today we are dealing with foreign exchange. So we will be dealing then with section 25D, section 24I, then paragraph 43 of the 8th schedule. So it's not going to be a long lecture, meaning we don't have a lot of slides to go through today. But of course, I will try my real best to make sure that we cover everything to the extent and also even the examples, what I'm talking about. All right. So guys, first of all, we just look at the fundamentals, of section 25 capital D. So this section 25 capital D, if you have a legislation, deals with exchange rates to be used for Forex transactions. So we all know that companies in South Africa and all over the world, they trade, amongst each other. And if it so happens that if you are a company in South Africa, you are trading with a company in the United States, or maybe anywhere in the world, even from Zim, there is differences in foreign exchange because the companies that they are using perhaps different currencies based in a country in which they are based. So this section then deals with that of what should then be used, as exchange for those Forex transaction and how it should be converted into a rand because we're in South Africa. Then on either side, we've got section 24I, which deals with exchange differences that arise now due to a change in the value of debt over time. So section 25D deals with the exchange rate to be used. And then section 24 deals with how do we deal with the difference that happens over time. Remember, sometimes you buy the goods now, but they don't arrive now. So you've got a debt. So it means that debt also will be subject to foreign exchange. So section 25D then one deals with the general rule perhaps that says then all the companies that are trading, they should actually take into account the foreign exchange currency income and expenditure, and must be translated into a rand by applying a spot rate on the date the income was received or accrued or expenditure or loss was incurred. This is the very important principle. So there is something called a spot rate. So it's a rate that should be taken into account. At what rate exactly when the transaction took place? At what rate exactly was the income received, perhaps accrued? At what rate exactly was the expenditure or loss incurred? This is a very important principle, which is actually outlined in a rule paper in section 5.1. Please mute yourselves, please. Please, this class, remember, is recorded. All right. So section 25 then D, section 25 capital D2 deals with the permanent establishment outside the Republic. So what if there is a company which is actually outside the Republic? So it actually states that the income and expenditures also must be translated to a rand by applying the average exchange rate. Now we are hearing, the second term, which is average exchange rate. The first time it was a spot rate. Spot rate is the rate of exchange at that day of the transaction. At that day, the income is received or accrued. At that day, the expenditure is incurred. At that day, the loss is also incurred. But now, if it's a permanent establishment which is outside the country, the income and expenditure must be translated by doing what? By using an average exchange rate. We go to 25D, capital D3. Then state that natural persons, now we're talking about me and you, natural person and non-trading trust. If you've got a trust that is not trading, may elect, now there is an option in this case, they may elect to translate foreign currency and expenditure loss by applying average for the relevant year or use the general rule, which is now 25D1, which is actually the spot rate. The spot rate, yes. So in this case, it means as for natural persons and the trust, they may elect to use these two. So you don't have to worry then about 25D, capital 2A, 4, 5, 6, and 7. Just worry about these ones. These ones are very important ones and will be dealt with in this class. All right. All right, guys, we've got a class example here. And as I said to you, I will try my real best, to go through this class. with you so that you get to understand and have, the basics of what's going on. So we've got Woods Pty Ltd. They earned interest from a foreign bank as follows. So 2022 year of assessment. So 1st of October 2021, they earned $5,000. 1st of November 2021, just 1 month after, they earned 6,000. Then 1st of January 2022, they earned 4,000. Now, we are given in this question the exchange rates. They say you may assume the relevant exchange rates are as follows. 1st of October, $1 was equivalent to 10 rand. 1st of November, $1 was equivalent to 11 rand. And the 1st of January, then $1 was equivalent to 12 rand. Now, the average exchange rate for the year was 10.15. We are given an average as well. So we are given spot rates per each date of the transaction and also the average. Now, they are saying to us now, they are requesting us, you are required to compute the amount of interest to be included in Woods Pty Ltd taxable income in the 2022 year of assessment. That is the question. Does anyone at this point have any question regarding the example? Just the example without actually going to the solution. Do you have any question for now? All right, I don't see a hand. I will assume that no one has a question for now. We can move on. All right. All right, so we've got the rule then, which gives companies the right to use perhaps the spot rate, translating the amount. So what does this then mean in this case? So in this case, it means we will go to 1st of October. We're going to multiply $5,000 with 10 rand because this was the spot rate at that, at that date. As you can see in the example, that is what happened, which comes to 50,000 rand. Again, we go to the 1st of November. We've got $6,000. Then we multiply by 11 rand. We've got 66,000. So as January, 4,000 multiplied by 12 rands, we've got 48,000. Sorry, guys. So the total interest, therefore, in this case is 164,000. Yes. But I think, guys, the principle, just the exam technique, when it comes to, when it comes to the Forex, perhaps to Forex, it's very, very important, to capture the dates correctly. If you happen to miss the dates and you kind of misalign the dates and the spot rates, you are in serious trouble because you are not going to get the correct, amount that you should be getting. So if you are a person that is struggling a little bit, you could then use a timeline. I always recommend a timeline, you see, because it assists you a lot, timeline, to be able to, capture the dates correctly. All right, we've got another example here of Mr. Lion Woods. He earned interest from a foreign bank account for 2020 year of assessment. So 1st of September, he earned $3,000. 20 September, $4,000. 1st February, $5,000. You can see this is a rich man we are talking about. He's getting all these amounts, as you can see, in dollars. This is not, any poor man we're dealing with here. But let's go and remind ourselves, if we are talking about the non-trading trust and individual, what do we use? Do we apply 25D capital D1 or 25 capital D2? Let's go back and remind ourselves a little bit. Okay, let's just look at 25D. Permanent establishment outside the Republic, they may use average. Okay, we are not dealing with permanent establishment outside the Republic. Let's go to 25D capital 3. Natural person and non-trading trust may elect to translate foreign currency income and expenditure and losses by applying the average exchange rate for the relevant year of assessment or use the general rule. Now we've got an option. We can go to 1 and we can also apply 3. 3 talks about an average, 1 talks about what? The general rule. Now let's go to the question again, to the example. We've got now Mr. Lion Woods here. Let's read. So this means in this case, because you've got an option, you can use any of the two. Now let's read. Mr. Lion here, you may assume the relevant exchange rate as follows. So 1st of September, $1 was 9 rands. And then 20th of September, $1 was 10 rands. But 1st of February, $1 now is 11 rands. You can see the dollar is actually, the value is actually increasing, yes. But we may mean maybe the rand itself, the value is going very down. The average then for whole year was 9 rand 50. Okay. Compute an amount of interest to be included in Mr. Lion Woods taxable income for the year of assessment 2022 year of assessment. So we go to the solution. Then they state that we've got a principle which is very clear, which is 25D capital 3, which actually state that natural persons may translate using, average exchange rate. They may apply average exchange rate, or they may use a general rule, which is the spot rate. So you can elect to use the spot rate, which can be, you can just use 9 rands. He can use 10 rands. He can also use 11 rands. But at the same time, he can also use, the average. And if he is using the average now, he just have to add everything and multiply it by 950. Now, in this case, he will use the average because it results in lower taxable income, which should be included in his what? In his taxable income, because this is an income. So guys, this is very important because there is a choice to a natural person or non-trading trust, and this choice may result in less tax, yes. So it means now it's easy to have a question. It's very easy to have a question that actually says, please explain to Mr. So-and-so whether he should choose the general rule, which is 25D1 or 25D3, you see, and give the benefits of that. Maybe just says give him the tax implications. So if there is this choice actually which is given by 25D3, you must be able to go ahead and say he is likely to use which option and why, as you can see in this solution. Okay, so guys, let's deal with 24I. So we've dealt with 25. 25 just specify what should be used, by the person that actually have a foreign, transaction. Foreign transaction mean you are actually involving yourself in a transaction which perhaps maybe with other supplier, which is actually beyond the borders of this country. So in this section then, 24I, how do we deal then with the difference? So we deal with affected contract, exchange rate differences. We deal with what we call exchange item. We will have something we call a transaction date. We'll have something called a realization date. We'll have what we call a translation date. We'll have something which is called intrinsic value, the ruling exchange rate, and also the local currency. Okay, let's first deal with the definitions. So your 24I then to state that companies, trading trust, natural person are subject to section 24I. So your 24I3 then state that Forex gains and losses, they should be included or deducted in taxable income. Now, what is this foreign gain? Let me give you guys just a simple example. If now I am buying goods from Zimbabwe, say, I get these goods now, let's say they were using $1. So I'm buying these goods when the dollar today, the transaction date, the dollar is 15 rands. I'm buying my goods. Okay, that's a transaction date. However, I'm buying these goods on credit. 10 days from now, when I'm paying, the dollar is no longer 15 rands. The dollar now is 17 rands. What does this mean? I will have to pay 17 rands to compensate, you see, the other party, the same amount. It means in my case, I'll be having the exchange loss. But it could be the other way around. It could be the reverse, for example. Because imagine if now, when the transaction date, it was 15 rands, all of a sudden now, the rand is strong and the rand is 12 rands now. Now there's a benefit now to me in a form of 3 rands. So it means it could be, either way. So section 24, I then state that any forex gain or loss on a bad debt needs to be reversed. Now remember, the bad debt may mean that the person have gone bad during the year of assessment. They will no longer be able to pay an amount. So you will need them to reverse the gain. Because sometimes you all the loss, maybe you had a loss, you see, but you may need to reverse that. So 25I6 then state that the forex gain or losses will be in place of any other deduction in the Income Tax Act. So it should be what? It should be deductible. Your servant state that you may defer your forex gain and losses if the underlying asset not brought into use. Now, this is very important, and we're actually going to deal with this. What does it actually mean? Yes, to defer the forex gains when the asset is not yet brought into use. You are able to do that. Section 24, I8 deals with losses on forex. You see, yes, you see, then actually also the prohibitions. They prohibited if main purpose was to reduce tax. In case now you had the main purpose was to reduce tax. We've got now, in case you see, how do we deal with that? If you just have, the transaction with the main purpose of reducing tax. So 24I10 then, capital A, exchange gains and losses only recognized when realized if lender and borrower in the same group of companies are connected. Sometimes you might have connected companies when you will have to, recognize a foreign gain. Section 24I12 deals with a person who becomes subject then to 24I because they are deemed to acquire the exchange item when he becomes subject to 24I. So when that person then is no longer subject to 24I, the exchange item then is deemed to be realized at that time. Okay, what are the bases of this section? So we've got then realized, unrealized exchange gains and losses on exchange item. So the exchange item then becomes an item. We can have what? Foreign exchange, you see, gain, you can have foreign exchange, you see, FEC, FCO, yes. We can even have the unit of foreign exchange. The unit may be the rand or something. You know what we're talking about, yes. Okay. So debt under this section also, you may have the loan or you may have, the advance, you may have all those things. So two then provides that a residence company or a trading trust and a natural person, you see, who then takes on these ones or hold the unit of foreign exchange is subject to section 24I. So non-resident are excluded unless, of course, we've got the what they call the permanent establishment. That's what they call in PE. So, which is, so if we were the permanent establishment in South Africa, the company is actually trading from South Africa, everything is in South Africa, then you'll have those things. So section 24I then, if then requires that the gain then should be included in income and loss also to be excluded from income. But gains, of course, they are termed exchange differences. Remember, I said to you guys, there might be a gain because you find out that I was supposed to pay 15 rands, but now I'm paying 13 rands. It's a gain to me. It's a loss if I'm paying 17 rands instead of what? Instead of 15 rands. Okay. So the three dates then, which are very important, we need to know is a transaction date. The date in which the transaction takes place, the translation date. The translation date is always the year end. At year end of a company, you need to translate that. Because at the end, you need to know how much do you owe, how much you see, all those things is very important. Then your realization date is the date when you effect the payment, when the payment is actually done. Let me make an example from my example of Zimbabwe. Say now I'm buying goods from Zimbabwe now. Okay. My year end is 30th of June. I will only be able to pay by 31st of July. So it means in this case, I've got a transaction date, which is today, where the transaction takes place. Then I will have a translation date. So the debt that I have, which is $5,000, I will need to make sure, because remember, because there are exchange differences. There are exchanges in currencies from today until the end of the year, which is 30th of June. At 30th of June, I will still need to say 5,000 times the rate at that date to see has there been a change. Say, for example, now the rent is 15 rands, but come 30th of June, the rent is 16 rands. It means I'm making a loss. If I were to pay that date, I'm going to pay 1 rand more. But remember, it may also be the reverse. It might be that maybe I'm paying a gain. There is also a difference now also between the date I actually do the payment, which is the 1st of July, which is the translation, the realization date, when now actually realize, and make sure that we pay the debt. You might find out that by 31st of July, the rand is even 20 rands. Yes. So the transaction date then is usually when the amount was received or paid by the borrower or the lender. And also the translation date is the financial year end of the company or natural person. And the realization date is when the outstanding amount is settled by the borrower. It's what I've just said to you guys, that 31st of July when I'm actually paid the amount. Now what you need to do, you need to identify the person and determine whether they fell within the scope of Section 24I. So these are natural persons, and also these are what? These also the companies that are in South Africa. You need to identify the exchange item. Do we have a loan? Do we have a debt? Do you have FEC? Do you have SOC? Do you have a unit of currency? Do we have anything of that nature? You need to satisfy yourself about those things. Okay? Then also, you need to identify the transaction, the translation, the realization date, and the ruling day rate on these dates. The ruling rate on these dates is actually the spot rate. But for loan advances or unit of foreign, the ruling will always be a spot rate. So guys, as you can see now, we are learning more things. We are getting more complicated a little bit. So it's very important for you now to start, paying more attention, because now you've got to identify these dates. You've got to identify the person. You've got to identify the item we are talking about. You've got to identify the transaction date, the translation date, the realization date. I said to you, the transaction date is the date when the transaction takes effect. The translation date is the year end. The realization date is the date when the payment is done. Then you need to establish also now the cost at the transaction date. What cost is it? We can use spot rate, or we can use, of course, what? If it's a natural person, we can use an average, or it's a non-trading trust. That's a Section 25(1). It's a rule, the spot rate, yes. Section 25 D2 talks about the company that are permanent separation in South Africa. Section 25 D3 talks about natural person non-trading trust. They may use any of the two. If it's revenue in nature, deduct under Section 11A, and if capital in nature, claim capital allowances. Now we need to know the asset we are talking about. Is it the revenue in nature? Because if it's revenue in nature, the expenditure will go to what? Go to Section 11A, which is a general deduction formula. I encourage you guys to go to the slides that I've posted relating to third year. They talk about these things to refresh your knowledge about Section 11A, what capital in nature mean and what expenditure in nature mean. You need to determine the exchange differences on the currency by multiplying the exchange item by the changes in exchange rates. I said to you guys, remember, I say I'm giving you an example of $5,000 now. I'm saying it's 15 rands today, but at realization date, so at translation date, which is year end, is 16 rand. On payment date is 19 rands. There are differences here. Now we've got to identify the differences. We just multiply now with the, we say 16 rand minus 15 rand multiplied by $5,000. We get to know the difference. There we go. We've got an example to deal with. We've got EGA Ltd. It's a South African residence company. They have a 30-year end June. Wow. On 1st December 2020, when the exchange rate was 5 rands, they purchased 50,000 worth of trading stock on credit. Okay, very important. They purchased this one on what? On credit. So it means they owe a person. All right, that's good. So the debt to the creditor is to be settled in full in 1st September 2021. Remember, they are buying these things when? They purchased this thing in December 2020. Now they will only pay in September 2021. In this case, we have a transaction date, guys. Tell me, what is a transaction date? We have here. Please talk to me, guys. Remember, you need to identify, first of all, a person. We've identified EGA Ltd. It's a resident company. Now we have to identify the exchange item. We can say they're having a date. Now we look at other things. Do we have a transaction date? Tell me, guys, what's the transaction date in this example?
1 December 2020.
Thank you very much. When they at the date of purchase, thank you. Do we have a translation date? Tell me that date or the realization date. So there are 2 dates now remaining. We've got to identify transaction date, translation date, and the realization date. So tell me the realization date and also the, actually start with the realization and start with the translation and realization date. So what is the translation date? Any one of you guys? We said the translation date, guys, is the year end. So in this, the translation date would be 3rd of June 2021. Then what is the realization date? The realization date is the date which the debt is paid. So tell me, guys, which is the realization date in this example? Hello, guys, talk to me. When will this debt, guys, be paid? Talk to me now. When?
1 September 2021.
Thank you very much. Yes, that is the realization date. Now, they carry on now to give us what? Now, the information that we need. So they say to us, the exchange rate was 7. So first of all, we know one thing, that actually, when this transaction took place, the exchange rate was 5 rands. Now, the exchange rate is 7 rands per dollar on this date. That is the payment date. The exchange rate is 6 rands on 30 June 2021. Okay. Now, guys, we can see automatically that we are having, if you ask me now, the Forex loss. Why? When we actually got this loan, when we actually went into this transaction, it was 5 rand. All of a sudden at year end, we have to realize a whole 1 rand difference. If we were to pay that date, we're going to pay 6 rand. Also, the actual day where we actually pay now, which is the 1st of September, we pay 7 rand, 2 rands more than what we should have paid. So it means we're having what? The exchange loss. Now they say here, determine the impact of the transaction on EGA's relative taxable income, 2021 and 2022 year of assessment. So guys, we need to know one thing now, 2021, 2022 year of assessment. So first thing, guys, we have to know, we'll have to, first of all, on transaction date, we're writing down, it's 5 rand times $50. Okay. That's a transaction date. That's a debt we have. Now we say 5 rands times 6 rands at what? At translation date, which is 30 June. Then we see there's a difference of 1 rand. It's actually 1 rand times $50. Then come again on the date. Now that is 2021, right? Financial year, because it ends there. Come 2022, we realize this amount we paid on 30th of, sorry, on 1st of September. 7 rands minus 6 rands times $50 should be the amount for what? For 2022. Okay, let's look here. As you can see, guys, they are saying you've got to identify the person, then do they fall within the scope of this section? So we've got to identify, now we've got the residence company, so they are subject to this. We're happy about that. We go on again, we've got to identify the transaction. We've got a loan or an advance. In this case, a foreign debt. Identify the transaction, translation, and realization date, and the ruling rates on these dates. It's very important. Which rate do we have in each and every day? It's very important. Now we can see transaction date. We've got one, which is 1st December, 5 rands. Then translation date, which is 30 June, 6 rands. Realization date, 1st September, 7 rands. Wow, it looks like we've identified that. Now let's go on. Establish the cost at the transaction date using section 25D. What does section 25D say? It says if it's a company, section 25D1, if it's a company, we use the spot rate. Now, what is the spot rate at that date? It's 5 rands. So we take $50,000 multiplied by 5 rands. We get what? 250 rands. Okay, perhaps it means in South African rands, it's 250 rands. It's deductible under section 11A. Why? Because it's expenditure and losses, you see, which actually incurred. So we bought trading stock. So trading stock is deductible. But if we bought an asset, it was not going to be deductible because it was going to be a capital in nature. Determine the exchange difference now on exchange item by multiplying the exchange item by changing the spot rate. When do we do that? We do that when? A translation date. When is the translation date? It's June. Now we say a translation date in June. Now it's no longer what? As you can see, they are saying 1 rand. Why? Because you've got your 6 rands, which is now 6 rands minus 5, then it's 50,000 loss. Now we have a loss that we've made, which is 50,000. Now we go on again. When we actually do now the payment, which is for 2022, what happens? It's actually 7 rands. So 7 multiply 7 minus 6, then we multiply it also another 50,000. Now you can see just for this debt, guys, it went up and up and up again to the extent that we ended up paying what? All 300,000. So this is what could happen, the worst that could happen in a foreign, exchange transaction. Things could go, to the south. And if you think things will be better sometimes, then they even becomes worse. Because, for example, in this case, things could be better. Sometimes imagine if the realization date it was just 450. You know what I mean? You're going to realize what again in that case. Another class example. Guys, do you have a question for this class example? Maybe a comment? Not really. Okay. All right, that's fine. So we'll do another example. Then I will assume that we are all, going together. We're all fine. All right, that's fine. Let's move on then to the next one, which is class example number 3. So we've got AN Ltd, a South African resident company with a 28 February financial year end. Now we've already identified the person. Sells a trading stock to a customer in Australia. Now we are the ones selling in Australia. Now we can see we've got a trading stock sold in Australia on 1st of June 2020 when the exchange rate was 5 rands. Now we've identified the transact item. The exchange item is a data. We've got a data that we've got a person that owes us a receivable. The exchange rate was 6 rands on 28 February 2021. When did we sell this? 1st of June 2020. When is our year end? It's 28 February. So when the exchange rate was one rand, then later on, Come year end, the exchange rate is what now? Is 6 rands. It means now in this case, because remember now, we're the one now receiving the money now. What's going on now? We're actually getting more. The customer had not paid at year end. The exchange rate on this date is 10 rands, which is 2022 now. Imagine, guys, this transaction date back as June 2020. We're still in 2022. We have not received the money. It's okay. Okay, it's fine. What can we do now? Let's get on. But now, let me ask you these questions now. Do we have, and please tell me the transaction date. Which date is the transaction date? We're looking for 3 dates. We're looking for transaction date. We're looking for a translation date. We're looking for the realization date. Which date? Tell me the translation, the transaction date, the translation date, and the realization date, please. Hello, everyone. Guys, talk to me, please. I just need these 3 dates, nothing else from you guys. After that, I will not ask these dates again. Of course, related to this example, I might, of course, ask these questions, going forward to other examples. Guys, please participate, please. All right, guys, it's very important. The transaction date is actually the date which we sell these goods. So, which is the 1st of June, 2020. That's a transaction date. Now, the translation date is the 28th of February, any year, because that's a year end we have. The realization date will be the date in which this customer actually pays us. But it doesn't look like we've been paid by 28th of February 2022. We're not yet paid. Now let's move on to point number 2. We are now importing an equipment to the value of $30,000 on 1st October 2020, when the exchange rate was 1 rand. Now we are the one now buying this asset. The machine was brought into use in a process of manufacture on 1st October 2020. Okay. The exchange rate was 6 rands on 28th February 2021. We settled the supplier only on 1st May 2021, when the exchange rate was 9 rands. We have not taken any insurance, if you ask me, in relation to this debt. So guys, we'll talk later about FEC, foreign exchange, currency and all that, what we mean. You see, yes. Okay. This is when you take an insurance, maybe to say, I'm insuring this debt. Okay, guys. So for the second transaction, please tell me the transaction date. Please tell me the translation date. Please tell me the realization date for the second transaction as well. Please, guys, talk to me now. I know you people can do better, I know. Please feel free to.
That's the 1st of October 2020 transaction.
Transaction date. Thank you very much for that. Then when is the translation date now? Guys, please participate, please.
Then the realization date is at 1st of May 2021.
Hello, guys. I'm sorry. I think my network failed me. I don't know what happened now. It's just kicked out of the session. Yes. My apologies for that. All right, guys, then so we're still talking about the second transaction, and then we actually able to identify the transaction date. We're talking about now the translation date. So guys, which date then do you think is the translation date? Okay, actually, we are asking a question from Motlawakwe. Motlawakwe, please talk to us. Which date is the translation date here? Okay, Motoko is still thinking about this. It's fine. Let's go on to Tabani. Tabani, please assist us now. Tabani, are you there? How about is Tulele now? Tulele, can you please now rescue us now? We need you. It's very important. Help us understand this. Okay. Maybe Yanga, you can assist us, please, guys. Now you are encouraged to participate, please.
Okay, just to confirm, the translation date is the date where the account will be settled.
Yes, no, that's a realization date. So the translation date is always the end.
Okay, on this transaction, I don't see where it says year end.
Yes, I think yes, 28 February. Yes, they say 28 February is the end. You see the very first the very
Okay.
so that will be our translation date. Yes, thank you very much for that. Yes. All right, then guys, what will be then for transaction number 2? What will be the realization date, which is now the actual payment date? Which date will it be?
The 1st of
1st
May.
of May,
Oh, thank you.
2021.
Yes, thanks, guys. Thanks very much. Thank you for that. Yes. All right, guys. So we managed then to identify these three. So we know the framework. We first identify the person, we identify the exchange item, then we identify our 3 dates. Very important. Then we move on. Now, they're saying here, determine the impact of the above transaction in ALTD for the 2021 and 2022 year of assessment. Okay. First of all, guys, we sold goods to a person. The person has not paid us. Okay. We sold the goods 1st June 2020. The person didn't pay us. It was 5 hours by that time. By year end, which is 28 February 2021, that was our first year end. The person has not paid us still. So it means in that case, what we have? Sorry, we have a Forex gain of 1 rand, which is 20,000 actually, because it's 6 rands minus 5 rands. Then come again, the person has also not paid us come year end of 2022 February. So it means we also have a Forex gain in that case, which is 10 rands minus 6 rands. Because 6 rands is the last day we use, which was what? A realization, a translation date. So we have 4 rands, which is actually 20,000 times 4 in that case. All right. For transaction number 2, guys, as you can see, in this case, we owe a person. We owe a person at year end, which is 28 February 2021. What happens? We've got now, first of all, guys, the first thing you need to know, at the transaction date, we've got to convert the goods. We've got to convert, sorry, the debt, $30,000 times what? Times by spot rate, which is 7. Because we're using 25 capital D1. So we brought the machine in 1st October. So in that case, we'll have to account for what? For the machine, we'll have to account for wear and tear, because we bought the machine for the purpose of manufacture. But on the other side, on 28th of February, now it's what? It's 6 rands. In this case, what do we have, guys? Is it foreign gain or foreign loss? Remember, it's spot rate, it was 7 rands, right? But now we no longer owe them 7 rands. We owe them 6 rands. Is there gain or loss?
The gain.
Okay, thank you very much for that. Now it means in this case we are going to realize a foreign gain, which is 7 rands minus 6 rands times 30,000. Essentially 30,000 rands gain. Then we settle these guys now on 1st May 2020. The exchange rate now was 1 rand. Oh wow, it's very big now. So what do? 9 rands minus what? 6 rands. We're paying a whole 3 rands difference, which is 3 times 30, whole 90,000, which is a loss. On that what? On transaction date. Okay, let's just go through. This is what they are talking about here. So you can see, first of all, we are using section 25D, which is a company. This is a company, we don't use the average rate. So even if, guys, there was the average rate, you are not going to use it. Hello, guys. I just don't know what's going on today. I keep on being disappointed by my network here, these things, and yes. So, yeah, I just keep on being disappointed by these things, this network story. All right, guys, let's carry on anyway. So we're saying, guys, we had transaction date $30,000 times 7 rands. We're using spot rate, why it's a company, then section 12C allowance. Now, guys, I encourage you to go back to capital allowances and just read what happens if it's a process of manufacturer, your section 11E, section 12 capital C, you need to do that because we've got to account now for this. Then we would unraise Forex gain. We had a gain now at year end because actually we owed less. But imagine now when we're making a payment, we had to pay all 90,000. Okay. Then, guys, there's something called forward exchange contract. Now, what is forward exchange contract? So this is where you are trying actually to cap the risk. There's a risk that the rand will go up or go down. You just don't want to pay more. So you go then to the authorized dealer. They will undertake to supply you a specific amount for a foreign currency at a specific rate, also at a specific future date. This is the rate then which the currency will be supplied, is known as the forward rate. So it's called the forward exchange rate. It's a hedging against forex exchange risk. You've got a hedge. So you are saying, I know there is a risk. I don't want to pay much. Let's talk about it. Let me buy a rate. This is what happens then. So in that case, then sometimes you may do it for speculative purposes. So your section 24I then, you've got to apply the transaction date, the forward rate per the contract. So you will have a contract. Say, for example, you are going to the bank, you are saying to the bank, no, look, man, I'm entering into this transaction. I'm so uncomfortable. I'm so uncomfortable with the things that are happening now in this country. You know, I might pay much. Please, let's agree that you are going to, irrespective of what happens, I'm going to buy the dollar at this much at that date. It's a separate contract. You can do that. You will have the translation date. You use the market-related forward rate for the remaining period on a similar contract. So it means now, guys, things are becoming more complicated. You know what I mean? You've got your item here. You still have to account for your Forex losses, foreign gain. But now you have an additional contract now which relates to this forward exchange contract that you also have to account for it. But you are just hedging the risk. Realization date, you use the spot date. Now, guys, this is very important. One, as for the forward exchange contract or the hedging contract, you've got to use the forward rate per contract. It will be given to you. On a translation date, which is year end, you will be given a market-related forward rate for the remaining period of what? Of a similar contract. At a realization date, you will have to compare the spot rate with the translation date to see whether there was what? There was a difference, a gain or loss. Okay. Now it means you may have two kinds of losses. You may also have two kinds of gain. You may have your gain realized on exchange item. You may also have a gain or loss realized for what? Forward exchange contract, your FSA. Let's get on. Okay. Now you may also have foreign currency option contracts. This is just an option to buy or sell foreign currency at a specific date. But remember, guys, what is an option? An option, you may realize or not realize an option. You may act or not act. You just have the right. So in this case, they say, in case you have got the foreign currency option, is an option to buy or sell at that rate, and on before or after the date, it will also expire. You may or may not buy. The FCOC then differs from FEC in such a way there is no fixed obligation. I mean, the foreign currency option, it's an option to buy. You may buy, you may not buy. It's up to you. The only cost to the holder is the option premium, which is full deductible. Then you may do this also for speculative reasons. What is you speculate? You estimate that things may change. You just want to buy low, you sell high, you may do that. Realized payment on exercise of right, you will have now to exercise the right of the forward of the foreign currency option contract. When it expires, sometimes maybe when you sell it, or maybe you see it. So then you've got to use what now? On a transaction date, you use nil if it's FCOC. On a translation date, you use the market value of FCOC on that date, divide by the foreign currency amount per contract. On a realization date, you use the market value on the date, divide by the foreign currency amount per contract. On a disposal date, an amount received or accrued from disposal divided by the foreign currency amount per contract. This one sounds more complicated. Okay. What are affected contracts? So section 2524I assist us then to give us a definition. They say then, you've got FEC or FCOC, which has been entered into a hedge in respect of a loan, advance, or a debt where such loan has not yet been incurred and is to be used to finance an asset or settlement expenses in an ordinary course of a trade. That is now what they call affected contract. So they say the debt has not yet been incurred and is to be used to finance an asset or settlement expenses in an ordinary course of trade. So affected contracts then are translated at forward rate on transaction and translation dates. So affected FEC sale of an asset or supply of service results in a debt. You will have a debt in that case, but you will have to use a ruling exchange rate on transaction and translation date of forward trade per contract. On realization date, you always use what? Your spot rate. Now, affected contract, on transaction date, you use nil. On translation date, any included or deducted amount in respect of premium, if there's a premium received, actually. On the realization date, you use the market value of FCOC on the date divided by the foreign currency amount per contract. On disposal, you use an amount received. From disposal, you divide by what? Foreign currency amount per contract. You may defer to year during which the option then actually exercise. Guys, just 1 minute, please. I need to just close the curtains now. Everyone outside can see me. Just 1 minute, please. Okay, thank you guys. I feel safe now. All right. Let's get on. All right. So we've got an overview of translation rules. So if a loan advance or unit of currency is to be translated at a spot rate on a transaction date, we've got to know the transaction date. We've got to know the translation date. We also have to know the realization date. In case it's an FEC, which is forward exchange contract, we use forward rate on transaction date, market related forward rate on translation date, and spot rate on realization date. In case it's an option, we use the value is nil on transaction date. We use the market value at translation date and the market value on transaction date. If it's an affected contract, we use nil at transaction date, premium paid on translation date, and market value on realization date. We've got an example, FEC example. What do we have here? We've got SAZ Ltd, which is a residence of the Republic. They acquire trading stock from a supplier in the USA, wow, United States of America, in an amount of $1 million. Sorry about that. Rich guys, they are buying, they're actually entering, in very big transactions here. The purchase price is payable in dollars, and the purchase is concluded on 1st October 2021. The payment is due on 1st April 2022. The taxpayer year end is 31st December. Now, we've got the transaction date, which is 1st October. We've got the translation date, which is the 1st December year end. We also have the realization date, which is 1st April 2022. But now we're still in 2021. To hedge foreign currency, now what they did here, they entered into a foreign forward exchange contract on 1st October for the supply of 1 million by 1st April. Now, this is what happens, guys. They go to the bank or maybe to whatever the finance house. They say, can you please supply us $1 million by 1st of April? Okay, which is fine. But then the bank is saying, I'm going to supply you with $1 million by 1st of April at 7 rands 40. Where do I get that? You've got the dates here. So we've got the spot dates at transaction date, which is 7 rands. The spot date at translation date, which is 780. There's the spot rate at realization date, which is 720. We've got now the contract. They went on and bought the contract. How much is the contract? 740. So at 1st October. 31st December 2021, 7 Rand 90. That's a market related of that contract. Now we've got to deal with the losses of the exchange item. We've got to deal with the losses or gains of FEC. Determine the tax implications of the above transaction for SARS Ltd in the 2021-2022 year of assessment. Let's look here. So 2021, we've got the cost, which is 7 million. It's allowed under Section 11A. Why? We are told it's a trading stock. But we also to deal with Forex loss. This Forex loss, what does it come from? At that 1st December here, what do we have? Which is the realization day, the translation date. 7 Rand 80 minus 7 Rand times 1 million. Let's say here. There we go. 7 Rand 80, we've got 800,000, a loss, Forex loss. Now, the date when we actually pay, which is 1st April. Okay, no, because we're still dealing with 2021 year of assessment. Then we go on now to talk about FEC, because we want to finalize that. We've got an FEC, but how much was the FEC? 7 Rand 90. So the market rate here in this case, the market rate of a related is actually what? 7 Rand 90 at what? A translation date. So we take that, we compare that with the 7 Rand 90 because we bought actually this contract by 7 Rand 40. Now, how much is it now? Now it's 7 Rand 90. Now we've got also what? The Forex, the FEC gain. We are gaining here because at that date, these guys, if they were to pay us, they're going to pay us what? 7 Rand 90 instead of 7 Rand 40, 500,000. Now, can you see here, we're able to hedge the loss? As much as we have the loss of 800, actually we made the loss of 300 because of that. The only way we were going to make a loss when it comes to the FEC was if a translation date, the market rate was less than 7 Rand 40. For example, if the translation rate, if the rate at the 1st December was 7 Rand 20, we're going to make a loss. Because it means if we were to pay this guy, we're going to pay them 7 Rand 40. However, it's actually 7 Rand 20. Let's go now 2020 of assessment. 2020 of assessment, remember, is from the 1st October, is from, we are paying now on 1st April 2022. How much are we paying? We will pay, in fact, if we must calculate the loss, first of all, the loss is 7 Rand 20 minus what? 7 Rand 80. If we calculate a loss of gain, it's actually a gain, a foreign gain. Look here. We've got the foreign gain at the transaction date, because now instead of 7 Rand 80 at year end, now it's 7 Rand 20. Yet we have 600,000 times 7 Rand, it's actually 1 million times 7 Rand 80 over, we're getting 100,000, which is a gain. Now let's go to FEC. FEC as the that date, which is a translation date. Now, can you see that we are actually circling? Now, this is what makes it painful now. We had to circle at 7 Rand 20, but we purchased the dollars at 7 Rand 40, which is FEC contract. Now we're having a loss now of all what? 700,000. We take the 790 at year end. Now we take the 7 Rand 20, which is the spot rate at realization date. We're making a whole loss of 700,000. So guys, it could go either way. You could be better off by taking FEC. You could also be worse off. It just depends. You don't know what might happen, you know. Okay. So solution. All right, now we've got another example here of GD Ltd. GD. I like the name of this company. They enter now in a forex currency option on 1st April 2021, in which they acquire the right to purchase. So remember here, this is now the option to purchase, not the contract. Now, the right to purchase 1 million at a rate of 7 Rand 70. It's a right. It's only the right, guy. It's only the right. not the actual purchase. On entering the contract, they pay a premium of 6,000. That's the only amount they incur at this date, nothing else. This right may expire or may not expire. This right may be exercised or may not be exercised. It's just a right. At 30 July 2021, which is financial year end, the spot rate is R7.80. The option is exercised only on 28 February 2023 on a spot rate of R8.20. Remember, guys, here, it makes sense because why they realize this right. And it's actually a gain. Because they had a right. They purchased a right to acquire 100,000 at R7.70. But now the spot rate is what now? Is R8.25. So it means they have a right to still buy it at a lower rate, which is R7.20 than R8.25. That's why they exercise the right. But do you think if they were to acquire this at R7, perhaps maybe if the spot rate was R7, that they had the right to acquire R7, were they going to exercise this right? No, because they're going to lose. Compute the impact of the above transaction on taxable income. Yes, okay. Now, 2021 year of assessment, they are just going to have the premium. What did we say? We said on a transaction date, you've got nil. Now, on a realization date, you need to have the difference. Then you divide by. Divide by what? You divide by the Forex item. So as you can see here, we've got R7.80. So R7.80 at year end minus R7.70 times 100 divided by 100, which is 0.10. So which actually mean what? Which actually mean, because we minus 9, we minus nil, but they didn't pay a thing, it's 10,000. So they'll have 10,000 in that case. That's why they're saying net here, because remember, they paid a premium of 6,000 to get this right. Now they're having what? They're having now 4,000. 2020 of assessment, they've exchanged differences. Now in this case, it's R8.25 minus R7.70 divided by, which is 55. So it's actually 55 minus that one is 45,000. They have a gain over 2 years, which is 49,000. Because it's actually 45,000 plus what? Plus 4,000. So they are better off because they purchased this right. But it could have expired. Now they exercised it. Why? Because they were gaining something. Deferral of gains. Now the gains and losses actually from FEC or FCO, they could be deferred. Where exchange differences arise from a loan, advance, or debt that is used to acquire the tangible asset, which or maybe intellectual property, they cannot be accounted for the year before the asset is brought into use. Remember, unlike the previous example, where the asset was actually brought into use when in October, here, the asset was brought into use immediately. But what if the asset is not brought into use? Now, this is where we talk about the deferral. So we can defer the losses. So actually they say here, where exchange difference arise from a loan, advance, or debt used to acquire a tangible asset, it cannot be accounted for in that year. If the trade is not connected or the asset is not used, the exchange difference is accounted for in the next year when it is brought into use. That's your 24I7. So the same principle then would also apply now to the related FEC or FCOC. So section 24I10 states that exchange gains and losses are recognized when the exchange item is realized for the following transaction: when the lender and the borrower form part of the same group or companies, or they are connected person in relation to each other, or the exchange item is not hedged. Now we need to know, is it hedged? Provided the loan is not funded by the independent party and is not shown as a current asset liability for IFRS purposes, no FEC taken on the loan. So what does this mean? The exchange gain or losses then are recognized when the exchange item is realized for these transactions. Now we deal with 12. 12 says that a person is deemed to acquire an exchange item when section 24I becomes applicable. So when this section applies, you are deemed to acquire an item. Then when this section no longer applies, you are deemed to have realized an item. So then we've got interpretation note, which says it was actually, it doesn't apply for 2023, but it deals with the reduction of debt as well as the tax treatment in case there is a waiver of a debt where the debt is dominated in foreign currency. And then you've got your paragraph 43 of the 8th schedule. What does 8th schedule deals with? 8th schedule deals with capital gains tax. It explains to you the principles that you must apply. Perhaps the paragraph that you must apply when you are dealing with a capital gain asset. So natural persons or trust, of course, if they acquire assets in foreign currency, subsequently dispose of in the same foreign currency, there will be capital gain or losses which is determined in that foreign currency. And that will be translated as spot rate. That's your paragraph 42. So paragraph 42, 43, also 43. 43, 1 capital A state that if it's a company, it's a natural person or trust. If there's an asset which is acquired in a foreign currency, subsequently disposed of in another foreign currency, will translate process at the average spot rate to local currency and translate expenditure also at an average spot rate. That's a very important principle to note. We've got an example here of an asset. The cost of it was 7 rand average. It was disposed for 120, but the average rate was 9 rand. So for individuals, we'll have what? The gain of what? 20,000, which is actually, we use what? We use the average rate, which is 9 rands. For a company, we'll have the gain of 120. We'll have, say, 120 multiplied by 9 rand. We've got 1,008,000. Then we've got the base cost, remember, which is 7 rand, which is the asset cost. We use also the rate there. Then we get capital gains at 380. Spot rate or average rate can be used. It's a benefit to what? To the taxpayer. Paragraph 43.5, there is a deemed disposal. Deemed disposal is when you are deemed to have disposed an item, even though you have not yet actually disposed it. So proceeds treated as being dominated by cards of expenditure, e.g. ceasing to be arrested. For example, when you leave, guys, the country, you are deemed to have sold all your things. Paragraph 43, market value at valuation date is dominated by currency of expenditure, which carries exactly. Therefore, then in terms of paragraph 43, 1 capital A, the translation is always a spot rate at valuation date. Okay, guys, thank you very much for attending the session. One man, one said, on filing for returns, this is too difficult for a mathematician. It takes a philosopher to do that. Thanks very much, guys, for attending the session. Do you have any questions for today's lecture? I don't see a hand.
Okay, I do have a question, but I don't know if it's correct. So I wanted to know which questions will require us, well, which sections will mostly be based on calculations, and which sections will need us to actually learn the theory so that we can describe the tax implications. Because
Yes.
I don't think we can grasp all of this information with all of these sections to pinpoint. Maybe, let's say, in a question, we have to identify maybe paragraph 8 of the 8th schedule and link it to section 24I, So I don't know, maybe to kind of give us an idea to make our studying easy as well.
Yes, my guy, I don't want to lie.
Yeah.
All these sections are important. And remember the way now they the way they ask now, the questions in text now, you know, they sometimes they don't say do the calculations, they just say tax implications. And if they are saying that they expect you to come from both perspective, they expect you to kind of tell the taxpayer what's going on. They expect you to do the calculations also for the taxpayer. So to be honest with you, I mean, all these sections are important and they deserve, I mean, equal attention. So I may not be able now to be specific to say which one really, you know, is not important. But I think the advice I may have for you guys is to go through again this video, go through again your slides, try a little bit to do examples yourself, you know what I mean, until you are comfortable. Because remember, the examples, you see, they will assist you to build your confidence. You see what I mean, about the topic itself. Until such time you feel like, wow, I understand what's going on. I understand now, you might not have understood everything. It makes sense. I mean, really, in this, like, I understand it's maybe it's too much for you guys. It's for the first time, maybe you're hearing about this, I understand. But I believe when you begin to sit down now, you know, you will make sense of things and begin to understand even better. And then after that, now you can be able to do some questions also in your own if you've got silk. If you've got, you know, other questions, try to do more questions now. You can say, wow, I can identify the translation date, transaction date, this date. I can understand this FEC, I can understand the FCOC, I can know how it's accounted for. That's the only advice I have, my man.
All right.
All right, guys. All right, guys. Thanks very much then for attending the session, and see you next week. Thank you very much, guys. Bye.
Bye.